Hello, everyone, and welcome to this Edison audio interview. I am delighted to be joined by George Barrow, who has worked on the financials team at Polar Capital for over 10 years. He is a co founder of the Financial Opportunities Fund and the Global Financials Trust, which will be the focus of this interview. Towards the end of our conversation, we will focus on the fundraising and the C share offer. But before that, there's plenty of topics to discuss. So, firstly, George, thanks for being here. And how have you and the team found working from home and working remotely over the past 18 months or so?
Yeah, afternoon, Elliot. Yeah, thank you for having me on. I think we've adapted well to it. I mean, I have probably a few more 2-year-olds in my meetings than I normally do, but that's the joys of working from home. But no, I think we've adapted well, and we have regular communication with Zoom. So I think overall the research process is largely unaffected.
I think recently you attended one of our meetings with HSBC. We had chief exec presenting there. Just how important is it to you as a fund manager to meet with management teams of potential companies and companies you hold?
Yeah, I mean, it is very much part of the research process. And before the restrictions were put on, we did travel frequently and would always meet management teams in person before making a new investment. And I think the access that we have had from knowing managements over many years, and then dedicating time to a particular theme or country on a trip was a very helpful part of the research process. So I think once restrictions lift, we will look to travel again, but we could sort of tweak it in the future. So if it's a management team we know well and have visited many times before, a virtual update could be a good alternative rather than in person.
Yeah, definitely. It's a lot more efficient in this environment. It can be, so that's good to hear. And then just delving into the portfolio. Firstly, looking at the subsectors of financials, and maybe you can start by maybe high level telling us why financials is such a good area to be invested in, but also on the portfolio. What areas have you been increasing your exposure in? Maybe fintech. You can talk about insurance or the banks. That would be really helpful.
Yeah, so we think the sector is still in the earlier stages of a cyclical recovery. So yes, we have seen a recovery from the lows last year, but we think that there remains attractive valuation upsides. As economies reopen, we expect loan demand to recover, and we expect macro data to come through quite strong and to be reflected in higher bond yields, which is clearly supportive for the sector as well. So, and also if we get current macro forecasts playing out, we'd expect the remaining restrictions on dividends and buybacks to be lifted as well. So that will allow for high yields to be paid, which could be in excess of 5% for US banks and high single digits for European. So a number of supports there that we view for the sector. And also we are seeing a shift in terms of policy response by governments, which we think is reflationary and certainly in contrast to what we saw post the GFC. So, given that backdrop, our key overweight is to the banking sector, which is the key beneficiary of the reopening and the reflationary trade. But we also see opportunities in non-life insurance, which is seeing a hardening rate environment. And then we have the sort of longer term structural growth opportunities in emerging markets and fintech.
Okay, great. And we'll come on to the subsectors in maybe a little bit more detail, but just on the capital restrictions that have been imposed, has that made the sector less desirable as an investment?
I mean, they faced a number of years of regulatory tightening before this point. So you've seen capital levels rise significantly. So what you have now is a much more resilient sector than you had before. And I think that was always a point that we looked to make, but people wanted to see how it responded during a downturn. And we've now had what has been a pretty severe downturn. The sector has weathered that well, albeit helped by high levels of government support. But there's no question that balance sheets are stronger. In terms of the sort of capital return restrictions, I think they were always intended to be temporary. It has been an overhang on parts of the sector, but they've now been lifted for the US banks, and we would expect them to be lifted later this year for European. So I think if you look at it in its entirety, you're going to have a sector getting back to paying high yields pretty quickly after a severe downturn. I mean, that's a significant difference to what we saw post the GFC.
Okay, great. And I guess over this period, markets have been very volatile and the performance has been really good after financials has very much been out of favor, I guess, over the longer term. Have you been trading more frequently? What's the sort of portfolio turnover currently at the moment?
Yeah, so turnover has been higher than it has been historically. So it's averaged around 60% in the last year or so, and that compares to around 30% on average in the period before the pandemic since launch. So, we did see heightened volatility. We rotated out of banks into more defensive sectors in the early part of last year. So raised areas like non-life insurance and fintech. And then, later on in the year, we raised emerging markets quite significantly. And we saw much more resilient trends coming out of Asia. And then later in the year, sort of from September, when there was more visibility on asset quality, we started to increase our banking exposure. And we felt that valuations had got down to levels, which was, too much of a discount, and we saw a strong recovery opportunity. So, we did shift the portfolio quite significantly, but we were seeing a sort of extraordinary environment.
Yeah, and you mentioned Asia there. I guess what's the percentage invested in emerging markets, and is that a really exciting growth area for you?
Yeah, so emerging markets is currently 17% of the trust. Long term, we think there is a lot of interesting areas within that, supported by lower levels of penetration. You've got structurally higher profitability, wider margins within the area. We find a number of very, very well managed companies, and often within those areas, they're sort of operating within oligopolies as well. So they have sort of moats in terms of defending their profitability. Right at the moment, we have seen EM recover quite strongly, sort of the end of last year, beginning of this year. So more recently, we have been reducing our EM exposure, but just to reflect sort of valuations and also second and third wave from COVID that started to affect certain countries. And that's allowed us to rotate into some of the more developed markets across regions that we think were sort of well placed for the next phase of the recovery. But long term, we think it's a very interesting area of structural growth for the sector.
Great. And perhaps you could give us maybe some examples of maybe recent additions or just particular holdings that you're quite excited about going forward that demonstrate your sort of investment philosophy and approach.
I'd say a good example would be OSB, which is a UK specialist bank focused on mortgage and buy-to-let lending. Market cap of around £2 billion. We've held it for a number of years in the trust, and it's demonstrated consistent ability to generate strong profitability, so sort of high teens, low 20s ROEs, and that's supported by very good cost efficiency, so cost income around 30%. We like the fact that it continues to take market share from the large cap banks, and whilst it grows at a relatively high level, it's been able to maintain a good level of asset quality, so strong asset quality despite the growth, and we think the risk controls have been decent. So, if you combine that with the fact that it's trading at 7 times earnings and 1.1 times book, we think that's very attractive considering its profitability and its earnings growth outlook. So, we think it would be a beneficiary of UK economic reopening and cyclical recovery.
Great. And just looking at that, obviously pays just over a 4% dividend yield forecast for next year. How important is income for I guess, the underlying companies that you invest in, and also paying that out to shareholders as a trust?
Yeah, I mean, we are sort of an income and growth vehicle, and so we look to sort of balance the opportunities within both. So, we would look to take a sort of balanced approach to that. I mean, historically, the trust has paid around a 4.4p dividend, which equates to around a 3% yield, and we've grown that dividend by around 7% per annum historically. In terms of the outlooks, given current restrictions on dividends, we would have to dip into reserves to maintain it at the 4.4p level. And so, given those uncertainties, we have told investors not to expect a dividend increase in the foreseeable future, but the board will reassess when we have more visibility in the next 12 months or so.
Great. And what sort of level are those dividend reserves? Obviously, one of the beauty of the trust is that you can go into that to maintain a dividend. How big is that reserve at the moment?
I mean, it is significant. So we would quite easily be able to maintain the 4.4p and cover it with reserves. But we are in a relatively uncertain environment in terms of regulation and in terms of the outlook. So we don't want to sort of overpromise in terms of the dividend.
Great. Okay, then I guess moving now into the more macro picture, much talk in the press, and indeed, we're starting to see prices increasing in various areas. How well do you think you'll be positioned for higher inflation?
Yeah, I mean, given the positioning of the trust with its key overweight within the banking sector, we are positioned for that reflationary environment. And within our banking exposure, the key overweight is to US small and mid cap banks, which are particularly sensitive to a rising rate environment given their revenue and lending mix. So, it would be a sort of key benefit for the fund if we get that coming through. It is the sector most sensitive to higher bond yields. And importantly, we have seen the sector become more sensitive to rising rates than it was last cycle. And that's because of a change in terms of the deposit mix. So we've had a sort of flood of money coming into non-interest bearing deposits. And on the asset side, banks have a lot of money sitting in cash, which can then be recycled into higher margin.
Great, and you have, yeah, I was just going to say you have a very much, bottom up approach to investing, but looking at potential interest rates rise if we do get high inflation. Would you say you're more of a more bullish on higher inflation over the near term, or are you happy just to see how the macro environment plays out and adjust your portfolio accordingly?
Yeah, I mean, we are currently positioned for higher rate and for inflation to come through. Um, if it doesn't to the same extent that we expect, then we would look to shift the portfolio as we have done in the past and sort of balance that with maybe a high weighting towards emerging markets or some of the sort of structural growth names within fintech and non-life. But as we're currently looking, we do see a number of sort of indicators that suggest we are moving into that sort of higher inflationary environment, and it's not just transitory. And just to give maybe sort of rough rule of thumb on that, I mean, for US banks, if we had 100 basis points rate rise coming through, on average, that would increase earnings by around 13% in year one. And in year two, that would increase earnings by around sort of high teens, 20% level as more of the loan books gets repriced. So you can sort of get a sense of the level of sensitivity coming through.
Great. And just looking back at what performance has been like, what should investors consider as the benchmark and the peer group, and then obviously maybe touch upon the very good performance that you've seen as we've seen this maybe cyclical rotation as well.
Yeah, so our benchmark is the MSCI ACWI financials. So we look across all countries. Thinking about performance, the trust is ahead of benchmark, and we look at the Lipper peer group since inception, and we've seen relative performance improve since the tender offer last year to around 15% ahead of benchmark at that point, and around 12% ahead of the Lipper peer group. So overall, the trust NAV is up around 110% since its inception in 2013, and that equates to around a 10% compound annual return. So, we've looked to try and construct a portfolio which gives that sort of global, diversified way of getting exposure to the sector, and have been pleased that the trust have been able to deliver those kind of returns in what's been a pretty volatile environment.
Great, and performance has been very good, as you mentioned. We've also seen a re-rating of the trust as well. I guess maybe you could explain to people who are not maybe that familiar with how the trust has traded relative to NAV, what's happened recently, and then maybe touch on the growth prospects going forward.
So on average, thinking historically, the trust has had around a 5% discount to NAV, although at times it has gone wider than that. At points it has exceeded 10% during moments of market stress. We have historically bought back stock when the discount has exceeded 10%. And post the corporate action last year, which extended the life of the trust indefinitely, subject to a tender offer every 5 years at NAV less costs. We would look to buy back stock if the discount exceeded 5%. But we've seen the trust move to a premium since around December last year, and we've been issuing stock from Treasury pretty consistently since that point.
Great. And I think I mentioned earlier on, there is a fundraising going on at the moment. When's that looking to close? And is that a C share offer as well that you're doing?
Yeah, so issuing a C share. So as noted, we have been issuing stock from Treasury since around December, and that's totaled around £80 million. But given the sort of reduced availability of Treasury stock and increased demand that we're seeing, we thought a C share made sense and being able to sort of offer investors the ability to invest to a larger extent. So that closes on the 16th of June. The feedback we've had to date has been positive, although it's always difficult to gauge accurately what final numbers might be. But yeah, so it closes on the 16th, and the conversion of C shares to the existing portfolio would be in August. So the two would run alongside each other for a short period. But in terms of makeup, they'd be virtually identical during that time.
Brilliant. Well, we wish you the best of luck in growing the fund and seizing on the opportunities out there. So yeah, George Barrow, thanks very much for your time.
Thanks, Elliot. Thank you very much.